Welcoming all the viewers to this educational channel, and I am presenting a class on the theory of capital structure. This class is especially on net operating income approach of capital structure. The theory of capital structure is an analysis or determination of market value of firm, which is the function of capitalized value of net operating income at the overall cost of capital. And this theory is stating net operating income approach. This theory is opposite to net income approach. Net income approach has recognized the importance of capital structure, that is debt, equity, finance is important while determining the value of the firm. But this theory is saying that debt, equity, finance is not relevant, and the value of the firm is depends on the earning operating income or earning before interest and tax and the overall cost of capital. So the relationship between earning before interest and tax and overall cost of capital, these two elements determine the market value of firm, and the capital debt equity mix is not relevant. And here it is saying capital structure is irrelevant, that is debt equity mix or the proportion of debt equity mix is not relevant and does not affect the value of the firm. So this approach is based on the following assumptions. The investors interested to know the firm as a whole and thus capitalizes the total earnings of the firm to find the total value of the firm. Investor interested to know the firm as a whole. In net income approach, the earnings available to equity shareholder is used to capitalize the equity share capital at cost of equity capitalization rate. But here the whole earnings is capitalized. In this theory, it is recognized that the whole earnings, so the investor means here the shareholders as well as debenture holders, both they are interested to know the total value of the firm, that is as a whole. And if both the investors are interested to know the total value of the firm, then the whole earning is capitalized, and which is the total value of the firm. This is the value of the firm. And this theory again assume that the overall cost of capital of the firm is constant, and the cost of debt is also assumed to constant, but the cost of equity capital is not constant. It varies with the increase or decrease of debt in the capital structure. Here it is point number 4 is saying that the use of more and more debt in the capital structure increases the risks of the shareholders. So it is talking about the financial risks that the shareholders feel when the more and more debt financing is used in its capital structure, and thus results in the increase in the cost of equity. And the increase in the cost of equity is such as to completely offset the benefit of employing of cheaper debt. And the next assumption is that there is no tax. And based on this assumption, the theory determines the value of the firm, and it establishes the relation with the overall cost of capital. And the following steps and terms are used for determining the value of the firm. Here the total earning is capitalized, this one. The whole earning is capitalized with the help of overall cost of capital. And this overall cost of capital includes cost of equity, cost of debt. V stands for total value of the firm, and earning before interest and tax and net operating income. Other terms are used here. So symbolically, KO overall cost of capital, add together the cost of equity and cost of debt, so whole. So one illustration is here to understand how the value of firm is calculated or determined under net operating income approach. So how the value of the firm is determined, and this illustration is helping you to understand for determining the total market value of the firm, total market value of equity shares. Here one illustration. A company expects a net operating income of rupees 2 lakh. It has rupees 5 lakh, 10% debentures. The overall capitalization rate is 20%. Calculate the value of the firm and equity capitalization rate, that is the cost of equity capital, according to the net operating income approach. And one more point here in this question, the total debts used by this firm is rupees 5 lakh. Then if the debt financing is 5 lakh rupees and the balance is equity share capital finance, now the condition is added here that if the debt financing is increased from 5 lakh to 6 lakh 50,000, then what will be its impact on cost of equity capital and value of the firm. So this is the second point to be analyzed with the help of this theory steps. And net operating income, this is given in the questions 2 lakh, and overall capitalization rate is 20%. Then the total value of the firm is to be calculated by capitalizing the EBIT at the overall cost of capital. So EBIT is 2 lakh, overall cost of capital is 20%, that is 20 multiplied by 100, so it is a reverse 20 by 100, and the 100 will go up. This is it. This part is capitalized value with the help of overall cost of capital. So this is how the earning before interest and tax is to be capitalized. And the total, this is the total value of the firm, 10 lakh rupees. So that this 10 lakh rupees including S plus D, that is in this 10 lakh rupees the market value of equity shares and the market value of debts together is 10 lakh rupees. Now if out of 10 lakh rupees 5 lakh is the market value of debenture is given here, the less market value of debt debenture is 5 lakh, then the balance amount is your market value of equity capital. This is the 5 lakh rupees. So using the weighted average cost of capital formula, so calculation of equity capitalized rate, that is KE, is calculated. So this is the formula used. WACC, weighted average cost of capital, weighted, that is the proportion of debt in total capital structure, in total capital, and proportion of equity share capital in total capital, that is the weighted average cost of capital multiplied by each element, the cost of debt, cost of equity. Substituting the value, this overall cost of capital 20%, so 20 divided by 100, so 0.2, and the cost of debenture is given 10%, so that is here 10 by 100, so 10 divided by 100, so 0.1 here, and cost of equity capital is to be calculated, and here this is, so all common zeros are 50, 50 cancel, then 5 by 10, and this is a 5 by 10 k, and after solving these equations the cost of equity is 30%. So verifications, here the verification, earning before interest and tax is 2 lakh rupees, and less cost of debt 10% of 5 lakh, it is 50,000. So balance amount 1,50,000 is available to equity shareholders. So the market value of equity share capital is 5 lakh, which is which is obtained in preceding page, 5 lakh rupees, and the whole earning is distributed to equity shareholders after the interest on debenture. This is 1,50,000 getting by equity shareholders, and their market value of share is 5 lakhs. Then 1,50,000 divided by 5 lakhs multiplied by 100, so this is the 30%, and here we have calculated the cost of equity is 30%, so this is the verification, so we are getting the same value and it is verified. Now the second point is here, then if the debenture amount is raised from 5 lakh to 6,50,000, then what will be its effect on overall cost of capital as well as the total value of the firm? The total value of the firm will remain same. The value of the total market value of the firm is remain same. Here the earning is constant. The overall cost of capital 20%, and then this is earning before interest, so it is a 10 lakh rupees, but this time the market value of debenture is 6,50,000, then the balance amount is the market value of equity capital 3,50,000. Equity capitalization rate, and this is the same steps we followed, only the debt financing is increased. In previous case it was 5 lakh and now it is increased to 6,50,000, and this, and the equity share capital value, market value is decreased 3,50,000 from 5 lakh to 3,50,000. Then the cost of debt is remain constant here 10%, and after solving these equations, so the cost of equity capital is 39% approximately. So in the previous case, when the debentures amount was used 5 lakh, then the cost of equity capital is 30%, and when the when the debt capital is increased from 5 lakh to 6,50,000, then the risks of the financial risks of equity shareholders increased, and the increase in the financial risks, and they are to be compensated by increasing the cost of equity, and here it is a 39%. From 30% it is increased to 39%, but the cost of debt is remain constant, earning is remain constant, only the cost of equity capital is increased because of more and more debt financing is used, then the financial risk of equity shareholders is increased. So this is the theory stating that the cost of debenture in both the cases is same, and overall cost of capital is also same, only the value, market value is also same, then the cost of equity capital is increased due to increase in the financial risks. So one similar problem is here to practice to you all. So all of you must practice this problem. Thank you very much.